Hi, everybody. Hi, Kareem, Richard, Hugo. Ronit, how are you, buddy? Ryan, how you doing?
Good morning, Dale. You all right?
Yeah, I'm doing great, buddy. So, can you see my chart, Ryan? Okay.
Yep.
So, it's a ruble.
Not
I'm just saying.
Can't see your chart. I can see the trade.
Actually, we see supercharger trading.
Well, you guys never mind seeing that, do you?
No, that's great.
Let's leave it up for the whole webinar. Anyway, here's the ruble. I'm just saying, it's a 3.
We should call it the rubble.
Yeah, the ruble that turned into rubble.
Yeah.
That has a 3 drive. And then this is the only other feature I really see today. It came off. These lines are, one's just a speed line and one's that long-term line. Look how it came off that line there in the euro. I don't like that it's weaker than cable, and still haven't gotten above 98 for the Dixie. So, but I think that's close. I think that the pound has to be the one that maybe leads the next decline. Because, Euro's already taken out these lows. And, God, the Aussie
Can I
really...
show you something quickly in the euro-dollar, Dale?
Sure, yeah.
Let me get it up. I don't know if I can show this clearly. Let's see if I can
Don't get it up, please. Morning.
Yeah, morning, Joe.
Let's have a look.
That was close enough for government work, unless we're going to have a throw under. But what do you got?
See that, guys?
Yes,
okay,
we
the
can.
Options.
Right.
The
This is something I've been looking at this morning, because this is the euro-dollar options. These are expiries over the next 3 months. The blue line is where we're at the moment, in the middle there. As you can see, we've got very little on the downside. The biggest expiry is around 110, which is going to be a big one in itself. There's barriers in play there. There's going to be a ton of stops sitting down below there. It's important because this is showing that the market isn't pricing downside at the moment.
Okay. So is that contrarian?
No, it's not contrarian. It means that if we get down there, if we break 110, it could cause a bit of a cascade much lower, because we're going to get all those option players then struggling and rushing to cover any exposure, hedging any gamma delta, not being in the right positions or being well out of positions, and that can cause it to, we get a fast move through there as traders scramble to get that protection, because that's a lot of what options is about. It's protecting ranges and things like that. And if you get a big shift out of the range, then it can cause some gaps. So that's something to pay attention to if we get down there. I'm expecting a decent barrier defense of 110 on at least a first attempt. Obviously, headlines and whatever's driving it down there. I'll be looking potentially for a long scalp into the 110 level. But just to say that if that does go, it could lead to a bit of a cascade.
Okay, good. Interesting. And let me ask you this. As you go to the right, the public's buying these calls, right? Or buying these options. It doesn't say if they're calls or puts. It's just open interest.
Yeah, well, on that picture I showed you, I've lost it. I've taken it off. Do you want to see it again?
Oh, okay.
I'll show you quickly.
Yeah,
again.
Put it up again. That's interesting.
So the calls and puts are down below, so you can see which ways those are all leaning. So you can see there's not, that you'd expect the puts to be on the downside, and there's not that many compared to the other side. But these aren't. This isn't retail. Market.
These are the banks. Banks will use
banks and institutions. Yeah, big companies as well. Companies hedge, profits and their fiscal stuff during the year. Which I'm sure Kay will talk about shortly, because we're in March and that's fiscal year end for Japan. So again, some more market info for you. We've heard that the big whale GPIF are potentially on the bid in dollar yen down into 114.50, you know, these are the whales you pay notice to. You know, if they're in, they're going to be in size, and they're going to potentially stick a big red line.
It won't die. The end. It just won't die. So, and you know, would love to see one more blow off up there. It looks like yields are trying to bounce from this 170 level. The speed of the move down to 170, I thought was, you know, telling. That was 30 bips that quickly.
Which combined with oil jumping, combined with gold jumping, you know, typical risk off move. You know, look at the Swissy, you know, Swiss absolutely cratered down to you know, near 101.50. You know, we're getting down towards the post cap pull from your SMB areas now. You know, it's so if you didn't have this mess going on, well, probably you wouldn't be down in these levels, but you'd be looking at the techs and you know, licking your lips at some of these levels. But the risk flowing around, it's hard for me as a macro fundamental trader to really look at any of these levels with great conviction, you know.
So these guys looking for 120, 125. I remember when Trader Vic was here, I asked him if he was looking for 120 oil like everyone. He said by March.
Might get that by the end of this webinar, Dale.
Yeah.
But the funny thing is with oil, you know, this used to be how it moved in the old days. You know, you used to move $5-10 in a quiet day. So this is catching a lot of traders out thinking it's wild. I remember you could move oil $3, $4 on a headline, you know, mild headline, something like NFP or industrial production or something. So this isn't amazing to me to see that oil jump so far. Okay.
I think it's kind of a no confidence vote on the State of the Union that he's going to be able to do anything. I think the president talked about 30 million barrels. What's that, one day?
It's nothing
that they put on the market, something like that. Yeah, this is amazing. So S&Ps, you know, when you think about it, think about what has taken out the lows or highs from the first invasion, the beginning of hostilities. And we know oil has, you know, that was, you know, 150. This was the invasion. It's way exceeded it. And the S&P still well above it. I think you have to respect how well it's held.
Yeah. It's still strange, you know. We got a bigger move when the Fed went all hawkish.
Yeah, interesting. Yeah, a tough environment. I don't know what you guys think.
Do you think that do you think there's a bit of surprise in the market, or a bit of I don't know how you
ambivalence?
Yeah, maybe the market isn't. You know, yes, this is a dangerous event, but the market is sort of putting its head in the sand and thinking it's, you know, we're not going to have all-out war over Europe. We're not going to have the unthinkable happen, and they're just taking it maybe not as serious as it could get, if you know what I mean.
Yeah, and where it is right now, you know, it might be a buy down here again, but you're right in the middle, and then, you know, here's 44.5, 45 should be pretty good resistance. I think there'll be sellers here.
Yeah.
But right here, what do you do?
Well, I've been saying,
you know, if you're not positioned. So.
Yeah, looking at the big figures, aren't we? You know, 44 is a big figure close by, 42 probably underneath, 43 in the middle, you know.
And the chart of the day was $1 yesterday.
Yep. I think morning. I was listening to what you're saying about equities. I think the trade is probably, you know what, buy stocks because there has to be a solution to this, you know, and we hopefully avoid a nuclear end game. Because if there is a bad scenario, well, your portfolio is not something you're going to be worried about.
We're all going to lose our hair.
Exactly. Well, I'm there already, but
we're all right. Yeah, high five.
We're going to lose our facial hair as well. But yeah, I mean, I think you're absolutely right. The stock market is the one that's, you know, pre-invasion, we're the same level or even higher, maybe. So,
Yeah,
you know, what
higher.
is the stock market trying to tell us? That's the thing, because like you correctly said, oil is spiked, metals are spiking a little bit, yields are going lower, everything kind of risk off is working, and then equity is just whistling and not caring.
Past the graveyard.
What are they telling us? You know, that's a really difficult thing to gauge, and I don't have the answer. I don't know. So
good morning, everybody.
Hey,
K-Man, how are you?
Yeah, not too bad. But you guys are looking at U.S. equities. Look at the DAX. Look at the CAC. Look at the European equities. They are the ones that move around really more.
Yeah, but
because they're closer to the zone. I know. I mean, U.S. equities are.
Well, there's your answers then from K-Man.
They're holding up, but the DAX lost 10% in a week, right?
Right. So it's that people feel more comfortable in the U.S. than in Europe.
I think so.
Yeah.
I think so. I think there's been some kind of rotation from European equities into US,
which is how it's been and was for a long time.
Yeah, and if you talk about currencies, that's probably also part of course, all commodities are higher. Part of the reasons that Aussie and Kiwi are holding up that well, it's because they're the furthest away from the action, right?
It's amazing it could be that simple.
Unfortunately or fortunately for traders, those kind of correlations can be that simple, in my opinion. Anyway.
Yeah, good points. So, you know, we're still the best sturdy shirt in the neighborhood. Remember that saying?
Yeah.
Yeah.
Till you lose it.
Till it becomes tattered.
Yeah,
it's an old shirt, huh?
I'm surprised cable isn't that well supported either, because, you know, with oil so much higher, you know, it is a commodity currency as well when it wants to be. You know, and Brent shooting through the roof, the same as you know, WTI. That can be a supporting factor for the pound. But like we say,
you think there's a few stops here?
I should imagine so. Yeah.
32,
I think 32, 31.
Maybe that's what they need to do first is, you know, the longs that are trying to hold on that thought they had a major bottom, take them out first.
No, you wouldn't be surprised. Depending on the news, it takes a couple of wrong headlines and we'll be through that in a flash. But you can say that for euro dollar, you can say it for all the other pairs.
Except Aussie, I mean, you know, except Aussie.
Yeah, and I'm, you know, talking my book, I'm loving the fact that it's looking so solid out, and I hope it stays that way if things do settle down. Then I can get back on my RBA trade. At the moment, yeah, it's holding up. When we said yesterday and a few days ago, it keeps coming back. You know, the dips happen and they're getting a bit shallow. Could be that we see a blow through on another move and take out that 73.20 area.
Yeah. Okay. Well, very strange environment. I mean, let's face it. We haven't. Who's traded in an environment like this?
Oh, well, they're all different, aren't they? You know, we've had these sort of things before, be it Iraq, be it Ukraine in 2014, you know, Afghanistan, or, you know, you name it. We've had these little conflicts, but this is one of the bigger ones.
Yeah, this is because it's
one
of the big boys.
Yeah, it's one of the big boys. So, no, not many of us. I mean, you probably traded through the Cuban Missile Crisis, Dale. You were probably sitting on the beach with your straw hat and pina colada, watching it all unfold.
I was 8, but yeah, I had a little. I was trading. So
8 or 80?
8. I'm 80 now. I feel like it. So, Steve, what do you think of this action? What could stop oil?
Some kind of de-escalation, which, as I said yesterday, doesn't seem very imminent, right? I mean, I think it's going to happen, but I don't think it's going to happen today or tomorrow, right?
Yeah.
So yeah, and the question is, the question that follows your question is, what's going to stop inflation from exploding even higher, right?
Paul Volcker resurrecting.
Yeah,
Right.
the only problem being is that the reason they're not pulling a Paul Volcker is because current economies are so broke, so over indebted, that you try to pull a trick like that, even attempt to bring real rates to positive territory, which it's the only way to fight inflation, right? Bringing real rates to positive territory. What that would mean, as we speak, if we took into account the actual inflation, would mean rates close to where Paul Volcker took them 40 years ago, 42 years ago. Even if we want to take the reported inflation as real, which it isn't, it would mean taking rates roughly to 10%. Can you imagine what's going to happen if they move rates to 10%?
Maybe oil is tightening for the Fed. It is a tax. So, and it is draining the inflation itself is draining consumer confidence. And I remember,
it is draining consumer confidence, but it's increasing the price of everything.
And their wallets.
Yeah, but that's the result of inflation anyhow. But increasing oil prices is increasing prices. End of story, right?
Mark Chandler once said to me that anytime right here on F.A.C.E, oil prices double, a recession is 6 to 12 months out. And I don't know what your starting point is going to be in WTI. It wouldn't be negative, but it's more than doubled.
In this case, if we're talking about the continuous one, we are 9 times up in roughly 2 years.
Yeah, that's what I mean. Yeah.
Yeah.
I mean, if you take it from $10,
$11, yeah. It's actually almost 10 times up now. Yeah.
You would think that, according to that thesis, a recession is definitely baked in.
I think a recession is. I think a recession is unavoidable. The problem is that we're now staring in the eyes the real probability of a stagflationary environment.
By the way.
Oh.
Hey, Blake.
ADP print was 475,000. So just a heads up. It's a pretty important piece of data that just came out.
Versus 388 expected.
Yeah.
But
So
remember last month we got that horrendous down 301 print, and then F.A.C.E came in massively up.
Yeah. Dollar yen's breaking higher, gold's breaking lower. Just giving you guys a heads up.
Good heads up. You want to come in here, Blake?
No, I'm going to let Steve finish what he was talking about.
No, I didn't have anything else to say.
All right. Good morning. How's everybody doing?
Doing good.
Oh, good.
Good. I was just,
sad times.
What's that?
Sad times to watch a war on TV.
It's amazing. I've got a lot of friends that have been reaching out to me, just asking like what's going on, and I can't tell you how many people are really. It's really upsetting. Affecting them. People are truly like really affected by this here in the U.S. And I'm just talking about just personal friends that I have. And I was playing tennis with a friend of mine last night, and he it was like. Got me down. I was like, I'm like, okay, I'm going to go drink a case of beer when I get back home from playing tennis. So that'll be fine. I'll get over it. But anyway, it is definitely a serious situation. Hopefully we can get some sort of ceasefire soon. That would be really, I just hope that happens. That can happen soon is what I'm thinking. But anyway, one of the things I wanted to talk about today is the dollar yen. Obviously we just got a strong ADP number, which is good. But you see the dollar yen actually popped above its 618 retracement, and it looks like, you know, we can make another stab higher. Now, as you guys know, we're in like this. Well, anybody who's in the ForexAnalytix community knows this. We're in an ascending wedge. Big resistance at 116.35. 117 is the major multi-decade resistance that Dale, you've pointed this out too. I mean, it's a big level. It's major. I mean, we're on a weekly chart, so you can see that high back in 1998. You guys ask yourself, where were you in 98? I mean, I was trading, probably whipping around in Amazon or Mindspring or some sort of .com market, but I wasn't trading currencies at that moment.
It's the year I finished high school.
Yeah, that means you were still popping zits on your face. Ryan, where were you?
I was on the life floor trading an account.
I was selling trunks of dollar yen.
Hey, look at now we got somebody who is actually selling dollar yen in size up there. And Ryan, you were on the life floor.
Yeah.
Dale, he was having
I was on the beach
with dinosaurs at that moment.
on the beach in Leucadia. The ocean.
There you go.
Backyard.
Dale was on the beach when he owned his own commodities broker or whatever you had at that moment.
Yeah, an IB.
Yeah, your IB. Okay, well, you know, the fact of the matter is back then in 98, you know, that was 24 years ago. That's when that trend line started. So that's how big this 117 level is. And so that's why I'm thinking if we make it up there, it's going to be very pivotal. You know, if we break it, that's going to be a whole new, that from a technical perspective, that's going to bring in a whole new, regime of where the dollar yen trades to. You know, we could be back in the 120s again. I mean, think about that. I mean, we haven't seen that since 2014. So that's why it's so big. And I'm watching it very carefully, and I want to continue to play dollar yen, you know, to the long side. Let's all understand the fact that it hasn't sold off when markets have I mean, you had the NASDAQ that really corrected near, was the NASDAQ composite down 20% at one point? Let's take a look.
Close.
Let me go find it.
Well, just quickly while you're doing that, I've just seen the revision in the ADP. It got revised from down 301 to up 509.
Whoa, that's crazy.
800k revision. That's bonk. They
Who
don't know
does
what
these
doing,
measures that
AD,
can go?
ADP. Oh, yeah. They're getting like the Canadian ones.
Yeah, it's private. I mean, so somebody was paid off. I'm just kidding. But the thing is, let's realize that the NASDAQ, even on the gap down, I mean, we were down 20%, but let's say we closed around 20% down. Let's realize that the yen has not caught a safe haven bid as a result. So, you know, if stocks recover at all, let's call it a ceasefire. Let's call it a de-escalation. What do you think is going to happen to the yen? And not just the yen, what's going to happen to yields? I mean, we had a correction in the bond market, which we anticipated, right? We had equal leg move, AB equals CD perfectly, bounce back as you would expect. Doesn't mean that the downtrend's over. It just means that we're having a correction. So why is the bond market catching a bid? Well, you know, people are a little worried about what's happening in Russia. So if things calm down a little bit and yields start to rally again, and we start to see that 10-year or 30-year yield start to pop back up again, what happens to the dollar yen? That's my question to you guys. And that's why I think, and then also I had to say this last night. By the way, if you guys are not in, let me just show you. This is the chat room. You guys see the ForexAnalytix chat room? This is what happens in just an hour. I got up right here, and it's been kind of a slow morning. Let's see. That would be me getting up right around here. Good morning. There's it. That's over just the last hour and change, right? That's in the general chat room. Not talking in the Forex flow. And Steve, by the way, This has to be changed to what are we calling it?
Flowonomics.
Flowonomics. Steve.
Yeah,
we
I
gotta-
know, mate.
Okay.
I bet you get your haircut with a flow bee, Ryan.
We have the trades room. We have the research room. So
I'd like to get my hair cut at all, Dale.
So guys, these are all just the chat rooms that we're in. And by the way, you get them included with your trader funding program. So if you guys haven't checked out the trader funding program, just go watch the little 2-minute video right at the bottom here. You can get to the site right from the ForexAnalytix site. But anyway, what I wanted to say here is I was just saying in the chat room last night, I'm like, guys, don't forget the big reversal we saw on a weekly candle in the gold market. I'm like, I know gold is up right now. And this is when gold was trading at 1945 last night.
Yeah.
I'm like, I know that, that gold's up right now, but I think you need to sell this rally. And I said, don't forget that there's a big reversal in gold. And I think you need to do it. And we've seen a reversal since then, but the fact of the matter is that was a big reversal candle. Now it's hard to do that when you're in a situation like we're in with Russia invading Ukraine. Obviously gold has been, a safe haven currency, but at the same time, technically the thing that we look at as technicians is where's your risk. And as long as you know where your risk is, like if you could look at that chart and say, okay, hey, I'm going to be a seller of gold. I'm going to put my stop above the 78% retracement or the 161% extension of an intraday move. Great. That's where my stop is going to be. Then your risk technically, because like I said, gold's one of those that is actually showing reversal. And now if gold reverses, there's a risk that the dollar yen pops its head right back above the 116 level. So just a few thoughts on gold and the yen. So what do you guys think here about yen? First of all, let's take a K-Man. You got a couple of minutes, but K-Man, yen trader extraordinaire. How do you feel about dollar yen here?
I think he left.
Oh, he might have popped out again.
Yeah, he was doing ADP, I think. So I don't know if he's still doing.
Oh, okay. So Ryan, since you're speaking, how do you feel about dollar yen here?
Yeah, but as I said earlier, we've had potential wind that the GPIF are on the bid down below into 114.50. If they've got stuff to do for their fiscal year end, there's going to be a ton of others looking to do stuff as well. We could just on that effect see it well supported, and we may be seeing some of that at the moment. But it's not shifting with a risk, and that's always even with all the headlines, it's on its grind. It's doing one of its grinding moves up. You look at the 15-minute charts or the lower time frames, it's grinding, and anywhere up towards 1575.80, that's the number to watch. Round about now. If we bust that, then we should get a move to 1600. Then once again, we're going to be looking at those 1635 highs. Which have become a bit of a boundary. Those are the levels we've got to take out if we're going to go up and hit your big trend line there. On the downside, we're finding a decent bit of support. Watch that 114.50 area if we get down there, because that's maybe where the action is.
All right. Well, thank you for your input there. Hey, one of the things I failed to mention is crude oil, and I shouldn't. I know we only have a couple minutes here. And maybe Steve or Stelios, if you guys want to jump in about this, but take a look at crude. I mean, that's a massive move. And Ryan, you can comment here because I know some countries are starting to release, the reserves, but take a look at this. This is a weekly chart. Now, I told our traders yesterday, I'm like, you can't, if you're doing technical analysis and basing any decisions off of that lower spike, you can't, because that was the day that the front month contract was down, $40-50 negative that day. That's when they had all the shipping containers out in the wherever sea it was at that point. So this is a CFD that went to zero. So I can't do extensions based on this. This
you can do on the continuous though.
You
because the continuous bottomed out at 11.
I don't know. I don't know if I'd even do it off the continuous, because it was the continuous is off from the front month contract by $50 or $40 at that time intraday.
Yes,
So,
but it was more accurate if you think about it, because it filters out all the noise, because
but
in essence,
you just said it's more accurate, but it's
mm.
not accurate. And it's not a number that everybody's going to be using. And that's the problem that I have with using any low that was created like that, that there's multiple lows on many different instruments. So I can't use that low to actually base any decisions off of. So as a technician, you have to kind of dismiss this and try to find other means of identifying where resistance might be. And so that's why I went and drew yesterday. I drew highs from, the 2011, 2013 highs. And that capped us yesterday. But look at us today. I mean, this crude oil market is out of control. And you know who I'm going to bring in tomorrow? Tomorrow on the Trader Summit side. If you guys don't go to tradersummit.net, check it out. It's free. It's where I do a lot of interview. Oh, there's Eric. He's coming up with Dale here in just a second. I'm going to sit down with Tracy.
Sorry, Blake, Powell's testimony's out for his appearance later.
Thank you.
We expect it will be appropriate to raise interest rates in March. Impact of Russian invasion of Ukraine on US highly uncertain. On US economy highly uncertain. So
I mean, it's going to be in line with what people think, right? They're going to raise rates, but they're not going 50.
Yeah, probably.
And they're not going to be aggressive.
And we'll get all the Ukraine excuses thrown in for good measure.
Okay. Interesting. Thanks, Ryan. But anyway, I'm going to talk to Chi Girl. So hopefully Friday, the interview will be out. I'm going to talk to her about crude oil and about these crazy prices. So make sure you're listening to us there. So guys and gals, remember, check out ForexAnalytix, $1 for 10 days to try it out. But if you want to try to get it for free, join the Trader Funding Program. You can have it included with the Trader Funding Program. You just have to do a one-time assessment fee and try to pass the assessment to get funded for a larger trading account. So with that being said, Dale, Steve, Stelios, Ryan.
Cheers, guys.
Yeah.
Bye-bye.
And K-Man, but I think K-Man jumped off. You guys all have a good one. Oh, he's there. I came at you earlier, but you weren't.
Microphone when you asked for the in.
Oh, I
was talking to my screen. At least my screen understood.
Did it answer back?
Yeah, it survived and it understood.
Unfortunately, we have a guest, so Eric's coming in. I don't want to take away from him and Dale. So, K-Man, we'll catch up on that a little bit later, I'm sure, in the chat room. So see you there.
All right. Thank you, team. Thank you very much. Eric, welcome back to F.A.C.E, buddy.
Can you hear me?
Got you now, Eric. How are you?
How are you? Doing excellent. How are you?
Good. Really interesting. People I use the word interesting when they can't think of anything else to describe an environment that's probably our grandfathers lived through things like this. So do you want to share your screen?
Sure.
Okay. So, I get your emails, Eric, and the feature of your last email, tell me if I'm right on this, is that you're talking about real incomes falling at a pretty good clip. And is that because of higher prices that, wages aren't keeping up with inflation, or is it something else?
Well, it's a little bit of all of that. It's that we have declining growth, and wages are ultimately tethered to growth. So you can't really have accelerating growth with accelerating wages with decelerating growth directionally. And then on top of that, we have prices that are continuing to rise in key goods. And by key goods, I mean goods without perfect substitutes. So the worst things to see rising prices would be food, fuel, and rent. So those are things that are difficult to substitute on a short-term basis. So that's what we're seeing the rise in, to a lesser extent rent now, just because food and fuel has sort of stolen the show. But people's incomes aren't going to rise just because oil went to $111 a barrel. But they're still going to have to put fuel in their car, so their real discretionary income is going to continue declining. So that's problematic. And just to sort of set the stage before we, I guess, move on to whatever else you'd like to discuss, I always show this chart, anytime I have a podcast or anytime I do an interview. This is sort of, this is my Coincident Index, which takes a composite of what I call the four corners of the economy. So any economy, whether China, Japan, Europe, United States, they all have income, production, employment, and consumption. Those four factors are what make up an economy. So what I do is I take the most reliable measure from those four corners in real terms. This is real growth, combine them together, and I track the growth rate. And that's what you see here. This is not a leading index, so this doesn't tell us where the growth rate's heading. This just defines the trend. And I've shown this chart every time I've been on your show. The growth rate is very clearly been in a downtrend since April of 2021. March of 2021, depending on how the revisions come in every month, it kind of shifts. But the peak was March or April of 2021. The growth rate's been declining. So we've been in a growth rate cycle downturn since March of 2021. It's not an opinion. This is just what the data shows. And again, this doesn't tell us that the growth rate is going to, where the growth rate's going to go from here. For that, we have to use leading economic indicators, which is what I write about. And every time I've come on your show for the past 6 or 8 months, I've shown this chart and I said the leading indicators tell us that we're going to keep grinding lower. That's still the case today. So this chart is going to continue to grind lower over the next several months. So as we set the stage for whatever the next part of the conversation brings, we have to contextualize the fact that we're in a growth rate cycle downturn, and that downturn is likely to continue. Okay.
And have you ever done a study, Eric? I talked to a lot of smart people, and one analyst said that anytime oil prices have doubled, there's been a recession 6 to 12 months later. And this has been more than a double in WTI.
Yes. So where that chart becomes relevant is if we look at this chart here. So this chart, if you can see this on your screen, it's real personal income excluding transfer payments. So this is all sources of earned income in the economy. So basically all this does is take out what the government transfers to people, but this includes wages, interest income, rental income, sole proprietor income, you name it, everything except what the government sends to people in the form of checks. And if you go to the last expansion, this was growing at about a 2.9% rate in real terms, which wasn't the greatest, which is why the last recovery was so subpar, because the economy couldn't really generate strong real income growth. But as prices rise, specifically oil and food, we're seeing real incomes deteriorate. And if you can see, I don't know if my cursor is showing on the screen here, we're hooking down even more. So we fell below the trend. We never regained the trend. And then we came up a little bit, and now we're rolling over even more.
Could I short it there? Any way I could get short?
You could short the consumer. That's what the short would be. But
how do I do that? S&Ps?
So this gap here is now $650 billion. So what that means is the consumer. Let me roll back a step. In economics, there's a very important concept called long run income. So Dale, if you were going to buy a big ticket item like a house or a car or something like that, or even when you do any type of planning, you have a mental projection of sort of where you'll be in 2 to 3 years or 3 to 5 years, somewhere in that range. It gets fuzzy as you get a little bit further out, but somewhere in the ballpark of 2 to 4 years is where people mentally project out where they're going to be, which is why these trend lines are important. So if we're sitting back here in 2018, 2019, people were making decisions based on their projection of where they would be in 2020, 2021, 2022. And a lot of people thought they were going to be up here by the red line. And what's actually happening is they're settling down here at the black line. So this is a huge gap between where people thought they would be and where people are in real terms. And that essentially translates to demand destruction because
Eric,
yes,
sorry if I may interject, Steve. When you say, I just have a question, right?
yeah, please.
I'm mostly an economist myself as well. I've actually studied finance. I have a bachelor in finance and one in business administrator, but I took a lot of lessons in economics because I really enjoyed them, and I am kind of a buff. When you say real personal income, I assume that also includes retracting inflation from it, correct?
Correct.
Yeah. So now my next question comes: do you believe that that reported inflation is
Accurate.
at or exactly at or nearly what the actual inflation is?
I think the CPI does a relatively good job at tracking consumer prices.
Okay. So you think it's a rather accurate measure of prices?
Yeah, I mean, everyone's personal basket will be different. So if you look at what the CPI is tasked to do, it's tasked to ask what's the general rate of inflation across a broad basket of goods and services across everyone in the country. So if you live in San Francisco, you may look at the CPI and say it's not accurate, but that's not what the CPI is trying to do.
No, I totally agree with you.
If you live in Idaho, the CPI is going to be different than someone in San Francisco. If you live in New York City, the CPI is going to be different. So yes, I think it does a good job of tracking consumer prices across a
my problem being that substitutions and hedonic adjustments, in my opinion, do a very, very good job in masking inflation in many respects.
Okay,
because let me
try a different angle here. Okay, this is real GDP per capita. So what you're basically saying is over the last 20 years, real GDP has grown at 1% per annum. That's what this last point is showing.
Yes.
If you're taking the position that the CPI is understated, you're basically taking the same position that we've been in a depression for the last 20 years.
Yes. That's exactly what it is, indeed.
Okay. I take the position that the growth rate's deteriorating, and this deterioration from a trend growth of 2.25, 2.5, collapsing to 1% is what we're feeling. I think that a lot of people are falling below zero because you have to remember real GDP per capita is the average. That's the average of everyone in the country. So, and we also know that the wealth gap is very skewed. So this is not the median. This is not saying that 50% of people are above 1% and 50% of people are below 1%. This is saying that average is 1%. So if you have people like Jeff Bezos and Elon Musk that are growing 100% per year,
they make up for millions of people that are on the other side of the equation.
So
in essence, what Eric says, because not everybody's right, very good at mathematics, there is a difference between the mean and the median. This is the mean, not the median.
Correct.
That's what you mean. It doesn't represent the average person. It just represents the mean of persons, which we know how skewed it is, as you said, and unfortunately it has become a lot more skewed over the years, right?
Correct. So I concur with your statement that a large percentage of the population is below zero. If you look at real GDP per capita as the standard of living, because that's essentially what it is. What this chart says is that the mean standard of living is increasing at 1% per year. So if you take everyone in the country's standard of living is increasing at 1% per year over the last 20 years, which is horrible. But significant portions of the population are well below 1% and likely below zero. That's what I believe you're getting at. But I do believe that the inflation is relatively accurate as far as the task that it's trying to accomplish. And I think that when people feel like we've been in this depression, I'm not saying that their personal experience is incorrect, but I don't believe the country as an average has been in a declining standard of living for the last 20 years. I think that the growth rate in the standard of living is falling. And what you're picking up is an extremely important point. It's that everyone feels rates of change. If your standard of living is going up 2%, and then it starts going up 1%, it's still going up, but you'll feel like you're going backwards.
Yeah.
It's a second derivative, which is why when I look at these cyclical trends, I always look at the second derivative, or the change in the growth rate. You can't look at this and say growth is 3%. You have to look at it and say growth is declining, because people felt 8% here. Now they feel 3% here. They feel the decline in growth. Mm-hmm. It's the same exact thing as saying growth was 2.5% on a long-term basis. Now it's 1%. We feel like we're in a depression.
No, we agree with everything you said. I agree with everything you said. We're on the same page. It's just added to that. My belief is that inflation is understated, so growth is also overstated. So even this meager growth that we saw in many years has been actually, in my opinion, real negative growth. But of course, this is not something that we can solve on this show, because it's so subtle, it's so easy to change a reported inflation rate of, let's say, 2%, if we take past years, to like 3.5%, which it is very easy to do and very hard to refute one way or the other. You know what I mean? It's just that I believe that all the methods of readjusting inflation.
Well, we have other measures to corroborate what's going on, such as gold prices, which is priced essentially off the real interest rate. If real interest rates were 400 or 500 basis points lower than what they're reported at, we'd likely have seen gold make a new high since 2012, but it hasn't, which has perplexed a lot of the people that believe that we have hyperinflation or runaway inflation. So there are a lot of asset prices and other means that we can corroborate this inflation rate. So I generally believe that it's as close to accurate as we can get. It's not perfect. It's an impossible task to nail it perfectly, but gold prices are lower than they were 10 years ago. They're rising now, and because but if the real interest rates were 100, 200, 300 basis points lower because inflation is 300, 400, 500 basis points higher, then it makes no sense that gold is lower than 10 years ago.
Yeah, but if you take in gold as a sole indicator about that, then even if we take the reported inflation, which is currently 7.5% almost, right, then the price of gold where it currently is doesn't make any sense in comparison to where the price of gold was when reported inflation a couple of years ago was 2%.
It does, because gold is a long duration security. Gold has an effective duration in the range of 15 to 20 years. And if we look at the inflation expectations 15 to 20 years out, they're still well anchored at 2%. So again, you have the bond market, the treasury market, that's corroborating long-term inflation expectations around 2%.
Yeah, for which the biggest buyer, though, remains the central bank, which is kind of my problem.
All right. We can go through this all day, but the Fed's not buying anymore. Why is the rate still falling? The Fed didn't buy.
It's buying less
2014 to 2000. No, they're not buying as of March. They're not buying. So why? Or the Fed didn't buy from 2014 to 2019. Their balance sheet actually contracted. The rate didn't go up. The Fed wasn't buying from 1980 to 2009. The rate went down.
Baked in the expectations, though, is that the Fed is going to keep buying whenever there is trouble. So let's see what happens.
Was there an expectation that the Fed was going to? Okay. Is the rate buying because of the Fed, or is the rate buying because demographics are pulling interest rates lower?
Both, in my opinion.
Why did the rate fall from 1980 to 2009 when the Fed was not buying and there was the word quantitative easing didn't exist?
Great question.
First of all, in the 80s, we had in essence the last period of history that we had actual booming growth again, right? Post Volcker and post Reagan, and then we had the internet in the 90s. So we had in essence a period of like roughly 15, almost 20 years that we had some kind of prosperity, let's say, right?
So you're saying that nominal GDP growth is tied to labor force growth, right? Based on this chart? Nominal GDP growth in black, labor force growth in blue.
Okay, yes.
Okay. Do you believe that interest rates are tied to nominal growth?
Nominal growth. Yes, somewhat. Depends.
Okay, here comes checkmate.
I mean, how could you look at this chart? I mean, okay, so nominal growth, labor force growth,
Mm-hmm.
labor force growth, interest rates.
Mm-hmm.
Are you correlated?
Where's
they
the
are.
issue?
They are, absolutely.
So what changed? Was point me to the spot on this chart where quantitative easing began.
So you think that quantitative easing?
I think quantitative easing drives interest rates up, not down.
Why would that be?
Go back to every single period where the Fed was doing quantitative easing. Interest rates rose. They didn't decline. Every time the Fed stopped quantitative easing, interest rates declined.
Yeah, but that also has to do with the market's mechanism of pricing in expected outcomes, right? Because
Bingo. So when the Fed does quantitative easing, people believe that inflation expectations are going to go up, that we're going to achieve prosperity, asset prices are going to go up. So inflation expectations rise.
And before it does quantitative easing,
interest rates go up.
Yeah, and before quantitative easing, with the exception of the first time, it has also photographed or prepared the market of what it's going to do. So the market is already pricing in what's going to happen.
Okay. Well, I'll take the side that nominal growth is what drives long-term interest rates, and nominal growth is driven by debt and demographics. I'll give you. All right, Dale. I'll ask you a question. If I told you a year ago, and I think I was on your show a year ago,
yeah,
that
we've been talking for a while.
Oil prices were going to go from 60 to 115. CPI was going to go from 2 to 7. The Fed was going to stop quantitative easing, and we were going to go from 0 interest rates priced into the Treasury curve to 6 interest rates priced into the Treasury curve. Right? That's the setup that I told you was going to happen. Would you say 30-year rates would be higher or lower?
Oh, yeah, higher.
Well, they went from 2.50 a year ago
down
to 2.15.
Yeah.
Why is that? The Fed's not buying. The Fed bought $10 billion last month. We're talking less than $1 billion a day on a market that has $600 billion of daily volume.
There's been a huge flow of funds into the bond market. Could it be foreign buyers making up that difference from the Fed? Who do you feel, where's the money flow coming from to replace Fed buying, Eric? Do you have an idea?
It's coming from vast amounts of sources. Okay. It's coming from private sector banks. It's coming from foreign banks. It's coming from private sector. My point is, we have to step back and understand that there's more going on to this equation than oil prices doubled, 30-year rates went down. Inflation went from 2 to 7.5. Interest rates went down. The Fed was a buyer of $120 billion a month to 0. Interest rates went down. I'll give you another example. The Fed was doing $120 billion a month of quantitative easing, over $1 trillion a year. And interest rates went from 50 basis points on the 10-year to almost 2%. How did interest rates quadruple while the Fed was buying $1 trillion a year? And then when they stopped, they came down. When did interest rates peak, Dale? When did 30-year interest rates peak? March of 2021.
Yeah.
When did growth peak? March of 2021.
So rates are more, so it's more of the market moving rates towards declining
30-year
growth.
interest rates are the most economically sensitive indicator we have. It's not controlled by the Federal Reserve. It's controlled by expectations of growth and expectations of inflation.
And that's why it's been flattening.
And exactly right. That is exactly why the curve has been flattening. It's exactly right.
I have one request from.
By the way, I love that discussion. I appreciate
it. Was great.
The back and forth. No, that was good. I like that.
Yeah, I mean, you and Steve, that you got to think about that.
Maybe we'll do a podcast.
Yeah. So I did have a request from an attendee. They asked if you could show the factor coincidence index for China before you go.
I don't have that indicator relatively readily available for China.
Okay.
What I do have is a more secular chart. So that's the cyclical trend. This is secular conditions. So this is again going back to these demographics. The only thing I would point out is that the working age population, 15 to 64, is what basically is the engine of economic growth. Why is that? It's because consumption increases from 25 to 54, and then consumption starts to tail off, right?
Yeah.
Pretty basic.
Yeah.
If we go to housing and vehicles, it actually peaks even earlier. So you need an economy that's very vibrant in 25 to 64-year-olds, preferably 25 to 54-year-olds. You need a very vibrant economy in that age cohort to drive economic growth. If we go to the major economies of the world, what do we see? We see the working age population started to contract in Japan in the 1990s. Japan went to 0% interest rates and they never got off, right?
Yeah.
In 2009, Europe went to contracting working age population. They went to 0 or negative interest rates. They never got off. 2015, China went to negative working age population growth. And there's a lot of reasons to believe that the China demographics are overstated. The number is actually even lower, but let's take it for what it is. 2015. What happened in 2015 in China? They did their first major devaluation of the yuan, August 2015, right? We had a Dow open down like 2,000 points that day. They tried to reflate their property bubble again, but point being is that it's not a surprise, Dale, that with a negative working age population, what are the headlines in China today? Real estate, right?
Yeah. Yeah.
How
so
do you?
this is all based on, so the demographic picture still looks the best in the U.S.?
That's right. And these are estimates from 2019. The numbers that are coming in for the United States over the last 2 years are coming in way lower than this dotted black line. So the demographics are deteriorating faster than the projections, but it's deteriorating everywhere faster than the projections. So China, Europe, and Japan for the next 10 years are going to have declining working age population. That's going to be insurmountable for their economies to overcome. Japan's never gotten off a 0 or negative. Europe's never gotten off a 0 or negative. China's going to have to figure out what they're going to do with their property situation because their economy is based on building apartment buildings, of which there will be less people to fill now, right?
Yeah. Yeah.
The U.S., this line, the dotted black line, slightly overstated. So we're going to be basically at 0, perhaps even slightly negative working age population as well. So that's
why it seems now post-COVID, Eric. Is that also a factor?
It is.
People leave the Great Resignation.
Yeah, and this doesn't include people by working age population. I don't mean people employed. I mean actual bodies.
Okay.
Labor force labor force is even lower. But this is just the pure number of bodies, whether you're actually working or not. This is just a working age. So when we're looking at this long-term 30-year interest rate, and we're saying, well, why can't this rate go up despite oil prices doubling, the Fed ending quantitative easing, interest rates rising on the short end? It's because it's a long duration security. It's based on the next 30 years, not the next 2 years. And baked into the expectation of this long-term security is how the hell is or better yet, who's going to be the engine of economic growth going forward?
So let me ask you this: with the real estate market in a huge bubble, bigger than we had in 2008, and these demographic trends, and houses don't die, could this be another do you think that the demographics are going to pop the real estate bubble?
Well, there are definitely different dynamics in this real estate market than there were in 2008. 2008. One example would be, I know we're running out of time here. This is household debt to GDP. So households aren't quite as levered as they were then.
Okay.
So that's one thing. Another thing is that a lot of households were extremely levered on adjustable rate mortgages.
Yeah,
there's less adjustable rate mortgages now. So I don't believe that the housing is the same time bomb that it was back then. But the other thing that I would like to point out, I always try and make this disclaimer when I talk about real estate, is that it's a very regional market. The two things that impact real estate are incomes and demographics. So if I come on here and paint a negative picture for real estate and somebody lives in a a market like, Palm Beach, Florida, and they say, well, my real estate market's booming. Granted, there's been over 1 million people that have moved to Florida in the past 3 years. So the demographics in Florida are quite robust, right? So I don't want to make any characterizations about anyone's local real estate market, because they could be in an area of the country that's experiencing very positive demographics. So they have more bodies, and the people that are moving there are high income. So you have higher incomes, better demographics. It would make sense to have a local boom in that real estate market. All I'm trying to say is that nationally, we have declining real income and we have declining working age population. That's going to set up a difficult situation for real estate as a whole. And if I could show one more chart before you kick me off here, this would be a leading indicator of economic growth. So I showed the coincident indicator. This is a leading indicator. Wow. So this tells us where we're going. And what is that? This is private borrowing rates. An 18-month change. Private borrowing rates is a composite that I put together that includes corporate borrowing rates as well as mortgage rates. We know mortgage rates have gone up quite a bit. And what this chart is basically showing, it's an 18-month change, is that private borrowing rates collectively have spiked over 100 basis points in the last 18 months. Historically, that leads to some problems.
Okay. And I tell you what, people want to hear you talk for another hour. You could do a course. Everyone wants you to be their economics professor, Eric. Really, enlightening. People are asking if they can see it again. Yes, it is recorded, and people want to know your Twitter handle. So
I think I have. Oops.
EPB research.
Yeah, let me see. Did my screen share go away?
There you go. No. There's all your stuff.
Okay.
Okay. There's where you could find Eric, one of the very good minds when it comes to economy. And I did. There were times where Steve really didn't have a response, and that's also a rarity. But Steve, you were right. I've been in a depression for about 20 years. So anyway, that was a great call by you. And
no, that was an awesome discussion. I really appreciate it.
The thing is that I agree on everything with Eric. It's just not, I just don't trust official inflation that much. So our only disagreement is where the baseline is, not where growth is heading.
Directionally, rate of change, we're on the same page for sure.
Yeah, exactly on the same page.
I'd like some help with my
with your depression.
My chronic depression. And there's nothing like money that kind of makes me happy for a little while. So anyway,
nothing.
You know what? I'm not depressed because I'm grateful for this interviews, and you can't be depressed and grateful simultaneously. So Eric, thank you so much, buddy.
Dale, that was awesome. Thanks for the conversation. I really enjoyed that.
Thank you.
Let's push this video and enlighten the Finchwood
it's going to be out in around 3 hours on YouTube, but as always.
And Steve, thank you for your great job as co-anchor today.
Oh, it's always my pleasure.
Okay, and I just went out and got some breakfast.
No, I'm glad you chimed in and turned it into a conversation versus having me rant into oblivion.
I'll be more than happy to do it again.
You don't rant. You edify, Eric. So I'll see everyone later.
Bye-bye.
You could join the team in 12 minutes on the morning edge. Good hunting today. And remember, trade with less leverage and let your stops breathe. Talk to you later.
Bye.
Adios.